Welcome to Trade Tactics TV. In today's video, we're diving into two important chart patterns, bear pennant strategy. Whether you're a beginner or an experienced trader, this video will cover everything you need to know about these powerful patterns and how to use them in your trading strategy. If you enjoy the content, don't forget to like, subscribe, and turn on the notification bell so you never miss out on our latest trading tips and insights. Thank you for watching. A bear pennant is a continuation pattern that often appears during downtrends, signaling that the price is likely to continue falling after a brief consolidation period. Below is a step-by-step guide on how to identify and trade a bear pennant. In the next classes I have shown about bull pennant. Today I will show you step-by-step guide to trading a bear pennant. Identify the strong downward move, flagpole. Look for a sharp, steep price drop. This forms the flagpole. This movement should be nearly vertical, signaling strong selling pressure. The volume during this initial decline is typically high, showing strong momentum. Wait for the pennant consolidation. After the strong price drop, the market consolidates, forming a small symmetrical triangle or pennant. The triangle should be relatively small compared to the flagpole, with price action narrowing as it moves forward. Volume during this phase typically decreases as the market pauses, signaling uncertainty. Watch for the breakout. The pattern typically resolves itself with a breakout in the same direction as the previous trend, downwards. As price breaks below the lower trend line of the pennant, a continuation of the downtrend is confirmed. Volume often picks up again during the breakout, reinforcing the trend continuation. Entry point, short position. Enter a short position when the price breaks below the lower trend line of the pennant. Some traders prefer to wait for a retest of the breakout level to avoid false breakouts, though this is optional. Set your stop loss. Set a stop loss just above the upper trend line of the pennant to minimize potential losses if the pattern fails. Determine your target, take profit. The target price is calculated by taking the length of the flagpole, the distance from the start of the downward move to the start of the consolidation phase, and projecting it downwards from the breakout point. For example, if the flagpole is 100 points, expect the next downward move to be around the same size. Example. Flagpole height, 100 points. Breakout point, $200. Target, $200, 100 points equals $100. A strategic approach is necessary when trading the bear pennant pattern, just like with any other chart pattern. Identify the market trend. It is important to confirm that the market is experiencing a bearish phase since the bear pennant is a pattern that occurs during a continuing downtrend. Look for a prolonged price decline, which suggests market sentiment is bearish. Spotting the pennant after a sharp downward trend, keep an eye out for a consolidation phase, which takes the shape of a pennant. This consolidation should be relatively small and not retrace more than 50% of the initial drop to maintain the downtrend's integrity. Entry point, the pattern signals a trade when the price breaks below the lower boundary of a pennant. However, wait for a candle to close below the pennant to avoid false breakouts and confirm the presence of strong bearish momentum. Stop loss. To effectively manage risk, place a stop loss just above the highest point within the pennant. This location safeguards your trade against the possibility of the pattern failing and the price moving against the anticipated direction. Take profit. To estimate the take profit level, you need to measure the flagpole's length. Then, project this distance downwards from the breakout point. The measured move helps establish a take profit level, suggesting the pennant triangle is the midpoint of the pattern. The 2-hour gold chart above shows the formation of a bear pennant where there was a strong decline in prices followed by a deep consolidation. The pattern was complete with a strong breakout below the lower boundary of the pennant. This strategy requires traders to wait for the price to decisively break below the pennant's lower boundary, a movement that signals the continuation of the prior downtrend. An increase in trading volume further strengthens the bearish directional bias. An ideal entry point is shortly below the breakout, once the price action and volume have confirmed the pattern's validity. To manage risk, place a stop loss just above the highest point of the pennant formation. This can help protect against bear. Observe the bear pennant until a clear breakout occurs below its lower trend line. This breakout should be accompanied by significant volume to confirm the bearish momentum. After a price trend line has been broken, it's common for the price to retest from below. This retest acts as a resistance and confirms that the breakout is valid. Enter a short position upon the retest when the price starts moving down again after hitting the resistance. Place your stop loss just above the highest point of the retest or the pennant's peak to minimize potential losses if the trend reverses. Measure the height of the pole and project it downwards from the breakout point to set a realistic take profit level, capturing the anticipated continuation of the downtrend. The bear pennant pattern is a powerful tool in the arsenal of technical traders, offering more than just signals for the potential continuation of downtrends. 1. Precise entry. Traders can use a pattern's clear formation and breakout points to set precise entry and exit markers, allowing for better control over stop-loss orders and strategic placement of take-profit levels. 2. Versatility. The bear pennant pattern is highly versatile and can be utilized across various time frames and market conditions. Whether you're a day trader who prefers to look at minute-by-minute charts or a long-term investor who analyzes weekly trends, this pattern can provide valuable insights. Furthermore, the pattern can be applied to various asset classes, including stocks, forex, crypto, and commodities, enhancing its utility as a versatile analytical tool. 3. Clarity in market direction. The bear pennant provides clear directional cues, starting with a sharp drop and a consolidation that confirms a bearish sentiment. This pattern, characterized by consolidation on lower volume, reassures traders of the downtrend's continuation. What is the psychology of bear pennant formations? The bear pennant formation signals a continuation of a downtrend as it begins with a sharp price decline that causes an asset's value to drop further. This initial move lower is a dump from the current investors as a poor news release or some other news negatively impacting the asset is released. The subsequent consolidation phase, or the pennant, represents a brief pause in this downward momentum. At this point, the sellers have become exhausted and need to catch their breath. However, they feel the downtrend is still early and don't want to close out their shorts. Some buyers may try to bottom pick prices, some short sellers take profit, and the price consolidates sideways. The price cannot rally as both buyers and sellers hold their breath. Volume dries up during the consolidation. Then, sellers begin to bring in more volume and the price adjusts lower. As the price moves lower, stop losses get hit, creating even more sellers and quickly pushing prices further down. Once the sellers are exhausted, they are ready to buy back, and buyers are ready to rush in to close the pattern. What is the psychology of bear pennant formations? The bear pennant formation signals a continuation of a downtrend as it begins with a sharp price decline that causes an asset's value to drop further. This initial move lower is a dump from the current investors as a poor news release or some other news negatively impacting the asset is released. The subsequent consolidation phase, or the pennant, represents a brief pause in this downward momentum. At this point, the sellers have become exhausted and need to catch their breath. However, they feel the downtrend is still early and don't want to close out their shorts. Some buyers may try to bottom pick prices, some short sellers take profit, and the price consolidates sideways. The price cannot rally as both buyers and sellers hold their breath. Volume dries up during the consolidation. Then, sellers begin to bring in more volume and the price adjusts lower. As the price moves lower, STO. The bear pennant pattern is a continuation signal in a downtrend, characterized by a sharp price decline followed by a consolidation phase that forms a small, narrow triangle, concluding with a breakout that resumes the downtrend. In contrast, the symmetrical triangle does not inherently signal a continuation or reversal but indicates a period of consolidation where the future direction is uncertain. This pattern represents a balance between buyers and sellers, formed by converging trend lines connecting lower and higher highs. The breakout direction from a symmetrical triangle can be either upward or downward, depending on which side of the triangle is breached. Unlike the bear pennant, which suggests continuing the prior trend, the symmetrical triangle requires traders to wait for the breakout to determine the market's next move, making it a pattern of indecision until the breakout occurs. As already discussed, the bear pennant signals a downtrend continuation through a sharp initial decline followed by a consolidation phase, forming a small, narrow triangle.